Hello, how are you? I hope you had a great weekend. It's time for the Jordan Dove Market Pulse for the week of November 7th, 2022. Again, I want to thank you guys for being here. I hope everyone had a great Halloween with their families. I really appreciate your guys' support. So thank you guys. Let's jump right into it. I'm going to have Las Vegas's market update released on Wednesday. So make sure you're subscribed to the channel so you can get what's going on in Las Vegas if that is something that interests you. So let's jump right into our review of last week. And we know that the Fed hiked rates and stocks slid as the Fed raised the funds rate by another 75 basis points for the fourth straight time, and the elitist Fed chair, Jerome Powell, said it was very premature to think about pausing. And stocks sank on his hawkish outlook after rallying at the beginning of Powell's press conference. It sounded like they may ease, and so stocks rallied. And as the presser went on, he said, hey, it's very premature to think about pausing, and then stocks absolutely tanked. Plus, there was a better than expected October jobs report, which showed the economy isn't slowing enough for the Fed to take its foot off the gas, even as unemployment inched up to 3.7% and the labor force participation slipped to 62.2%. Real inflation-adjusted hourly wages are shrinking with 4.7% wage growth, which is well below the roughly 8% inflation. ISM manufacturing and non-manufacturing indexes still showed expansion, though manufacturing bordered on contraction. Last week ended with the Dow Jones down 1.4%, the S&P down 3.3%, and the NASDAQ down 5.6%, which gave up a lot of the gains it had during that bear market rally. Following last week's rate hike, bonds also tanked. The 30-year UMBS 5.5% down 0.86 to $98.17. And in Freddie Mac's primary mortgage market survey, the national average 30-year fixed mortgage rate dropped back 13 basis points. That's 0.13 of a percentage point. And remember, mortgage rates can be extremely volatile. They change every single day. They change hour to hour, minute to minute. So check with a mortgage professional like Chuck Barone with Right Choice Lending for up-to-the-date information. In other economic news, U.S. payrolls surged by 261,000 in October, and that was better than expected as hiring remains strong. Now, I don't know how many people are working 2 jobs or 3 jobs, but there is a subreddit on Reddit called Anti-Work, and people are complaining about how many jobs they're having to work just to make ends meet. It's pretty rough out there, and I hope everyone's doing okay. But anyways, non-farm payrolls grew by 261,000. That's better than the estimate of 205,000. The unemployment rate moved higher to 3.7%, while broader jobless measure also increased to 6.8%. Big job gainers by industry included healthcare, professional and technical services, and leisure and hospitality. Average hourly earnings rose 0.4% for the month and were up 4.7% a year ago, and that still remains below the current inflation numbers. Labor costs show a slower rise while trade deficit widens and jobless claims nudge lower. Unit labor costs increased 3.5% for July to September period, below the 4% Dow Jones estimate. The September trade deficit widened to $73.3 billion. That's $1 billion more than was expected, and that is up from August's trade deficit of $65.7 billion. The unemployment rate for black men fell in October, but so did labor force participation. The rate fell to 5.3% in October from 5.8% a month earlier, and that's according to data from the Bureau of Labor Statistics that was released last Friday. This was for the wrong reasons, however, because labor force participation and the employment to population ratio fell. Black and Hispanic workers still have higher rates of unemployment than white counterparts. And how about those treasury yields? Every Monday we track the inverted yield curves and the 2-year and 10-year spread. And after rates were down last week, we have large increases this week with a 30-year up 9.5 bips to 4.291, which is slightly higher than the 10-year at 4.209. That's up 13.6 bips from last week's reading. The 5-year is inverted, meaning it's higher than the 10 and the 30 at 4.393, which is up 14.5 bips. And a larger spread on the 2-year, it's up 22.5 basis points. That's a large increase from last week to 4.724. I think we're going to see that 2-year at 5 relatively soon. Everything else will keep creeping up, but I don't know who's buying the U.S. debt. Really interesting. The federal government, the Fed is sitting on trillions of dollars of debt at 1%. I have no idea how they're going to unload that. Let me know how you think they're going to unload that. I'm really interested to see what happens there. Now let's talk about our national housing market update, which is my area of professional practice. If you're looking for an agent, my information is in the description of this video. You can go to jordandove.com, click schedule an appointment with me. We can do in-person, Zoom, whatever. I'd love to talk to you about your goals and help you navigate this changing market. So moving into residential construction spending for September, it held pace with August at a seasonally adjusted annual rate of $918 billion, which is now 12.7% ahead of 1 year ago. So there will be more new homes coming on the market. The next release of construction spending is slated for December 1st, 2022. Realtor.com reports the active inventory of homes for sale continues to grow and is now 36% above its level a year ago. So we have a huge influx of inventory. This followed the prior week's 34% increase, the first big gain in inventory since July. Now, I know they're telling you out there high interest rates, high prices, low inventory. Prices are coming down. Prices are coming down. Rates are going to remain high and inventory is up. So I don't know why they keep saying this stuff and this fluff, but that's absolute nonsense. You get the real information here, okay? The PwC and Urban Land Institute expect that days on market for listed homes will continue to rise in 2023, which will be good for buyers, and average home prices should be 30% higher than before the pandemic, which is good for sellers. However, it's my personal opinion that prices will come down to pre-pandemic levels for better affordability with these higher interest rates. I would suspect interest rates to come down to about 5% in the latter part of 2023 or Q1 2024. I think that there is going to be some prime opportunities around that time. And if you haven't gotten my playbook on how to take advantage of this changing market, and what's going to happen, please go to my Substack, jordandove.substack.com, enter your email, and then go to the playbook. You do not want to miss out on the playbook. Go get it now, all right? You don't want to miss out on it. Do not miss out on these opportunities. Wall Street is waiting to pounce. Private equity is waiting to pounce. They're ready to go. They're just waiting. Make sure that you're at least thinking about making a move when they start making a move, because we will see a nice appreciation run again. iBuyer, Opendoor, lost nearly $1 billion in Q3 in a once-in-a-40-years market transition. In total, Opendoor suffered a net loss of $928 million between July and September, according to an earnings report Thursday. That's up from a loss of just $57 million during the third quarter of 2021. In a shareholder letter, Opendoor attributed $573 million of its net losses to inventory valuation adjustments, or in other words, the reduced value of the homes Opendoor has in inventory. So home prices are coming down. That's what that means. Little did you know real estate analytics firm CoreLogic reported home prices dipped 0.5% in September, but they're still up 11.4% from September a year ago, but that's a slower annual growth rate compared to the prior month. Now, looking at the CoreLogic HPI, which provides measures for multiple market segments referred to as tiers based on property type, price, time between sales, loan type, which is conforming or non-conforming, and distressed sales, broad national coverage is available from the national level down to zip code, including non-disclosure states. These large cities continued to experience price increases in September, with Miami on top at 25.6% year over year, Washington, D.C. at 6.1%, Boston at 6.5%, Los Angeles 7.5%, Chicago at 8.4%, Denver at 9.5%, San Diego at 10.9%, Houston, who just won the World Series, at 13.1%, my hometown of Las Vegas Vegas, go Knights go at 13.6%. Phoenix sitting at 13.8% year over year. And the biggest winner year over year is Miami at a whopping 25.6% year over year price increases. Now, currently, the highest median price state in the country is Hawaii, with a median home value of $636,400, and the lowest median price in the United States. Can you guess what it is? Pause the video, drop it in the comments. Let me know what you think the lowest median price state in the United States is. And it's currently West Virginia with a median price of $123,200. Did you guys get that one right? On Wednesday, I'm going to have the Las Vegas market update. That will be out. So make sure you're subscribed for that if you're interested to hear about what is going on in Southern Nevada. You know, I believe Las Vegas is one of like the canary in a coal mine, where what happens here may happen in a lot of other metropolitan areas because we go up fast, we come down fast. So keep your finger on the pulse for Las Vegas to get a good feel of what's happening in major markets. Now, forecasting this week, we have inflation is forecast to come in by even hotter in October by the CPI, which is the Consumer Price Index. Unfortunately, initial jobless claims are also expected up. And not surprisingly, the University of Michigan Consumer Sentiment Index should remain at its recent historically low levels. And to finish this week's Market Pulse update, we are forecasting Federal Reserve policy changes in the coming months. The futures market now sees 0.5% rate hike in December and February, then a quarter bump in March as the Fed eases up but does not pause. The current rate is 3 3/4 to 4%, and there is a 100% consensus that rates will be 4.25 to 4.5 after the December 14th FOMAC meeting, and a 65.9% consensus that rates after the March 22nd FOMAC meeting will be between 5 and 5.25%. All right. So tomorrow is election day, November 8th. Make sure you get out and vote, guys. It really, really matters. You can make a huge impact at your local level and where you live. And that's very, very important to you. It's important to me. I want you guys to let me know what you think. Is the Democrats going to remain in control of the House and Senate, or will Republicans take over the House and possibly the Senate? Is there going to be a red wave, a blue wave? I don't know what's going on. You got one side running on abortion, and that's about all they have to run on. So I don't know what's going on. I want to know your thoughts. Leave them in the comments. Take care until next time. Please be well.